Good day and thanks for joining us. 2025 has been marked by an almost relentless stream of news flow. As South Africans, we've at times been holding our breaths, wondering if the government of national unity is going to hold. And now we have a pending inquiry or commission of inquiry into police corruption, just highlighting the destabilizing force of crime and in particular organized crime on individuals and businesses in South Africa. But there have been some green shoots. We got the budget passed, and with good fiscal discipline in the application of the budget. And then some really great news of late has been on the privatization front, as Transnet has conditionally approved 11 private train operators to operate some of the key rail corridors that take goods to our ports. This has been a key constraint on growth for a number of years, and if successful, should lift growth meaningfully in the future. But if one looks at the level of investment, and in particular into infrastructure, it's still been painfully slow. We've had a lot of political uncertainty this year, and as a result, business confidence has again softened from the lofty levels that we saw after the formation of the GNU last year. On the global stage, news flow has also been prolific, probably even more so than in South Africa. One just looks at tariffs. After the initial tariff announcements in April, there was some hope after the pause that tariffs would settle at more reasonable levels, but where we sit today, the implemented tariff levels are at elevated levels, and particularly so for South Africa. Against this backdrop, it might seem surprising that markets have been so resilient. So today, I just want to speak to the performance of the personal trust retirement funds and give some context to what has driven these returns. If we start with the personal trust conservative managed fund, the fund has gained 9% year to date and almost 13% over the last 12 months. The fund targets inflation plus 3, which one can see in the grey bar, and returns have comfortably beat this target for this year and over the last 1, 3, and 5 years. If we then add in the peers, which is the yellow bar in the charts, one can see that the fund has also produced solid returns versus funds that target similar returns in the category. Moving on to personal trust managed fund and prudent funder funds, these two funds have a higher target of inflation plus 5%. To achieve this kind of real return, one needs growth assets, that is equities, to deliver real returns. And for a number of years, this was really challenging within the South African environment. But we've seen a turnaround in the performance of the South African market, and this has lifted returns, as you can see in the chart over all periods. So looking at year-to-date 1, 3, and 5 years, both funds are comfortably above that 5% real target. Adding in again the peer group, the funds have delivered competitive returns against other funds targeting similar outcomes. So moving on to what has driven returns this year. I want to start with the SA equity market. We have 3 broad sectors: mining shares, industrials, and financials. Mining shares are typically divided into 2 key groups: diversified miners, and you'll be familiar with Anglos and Billiton in that group, and then the precious metal miners, which is gold and platinum. The chart you can see shows the contribution of returns from the key sectors I've discussed for the year to date. One can see that diversified miners don't make it onto the chart, and that is because the collective return of the shares in that sector have been fairly flat over the last 8 months. Precious metals have been a key driver of returns, making up about half of market returns this year, and that has been mainly due to the gold price, which has seen a spectacular rise as people have looked for alternative safe havens to the US dollar and treasuries. And then industrials, which is a mixed bag of global and local companies, has had a very good contribution to returns this year. What has been disappointing has been the contribution from financial shares. This largely is the banks, but makes up all financial companies in South Africa. They're a big part of the South African economy and a big part of the market, but returns have been pedestrian, just emphasizing the challenges that South African businesses face today. So if we look at the precious metals, I've spoken to gold, but it hasn't just been gold that has rallied this year. The platinum price has also rallied significantly. So both the precious metal sectors have done exceptionally well. At the beginning of the year, they only made up about 10% of the market, and their stellar performance has seen that weight almost double as part of the total index. Within industrials, Naspers and Process have done very well, as have a number of the Rand hedge companies. But then the telecommunications companies, which have lagged for a number of years, MTN and Vodacom, have also had a good year. And while the performance of financial shares has been lackluster, there have been some of the banks that have done well. So if one brings us all together, it's been a narrow group of companies that have driven returns, but collectively the market on the back of these returns has risen 22% this year. We've also seen really good returns from the bond market. The All Bond Index is up just over 10% over the last 8 months, and this has been driven by a number of positive factors. We've had continued fiscal discipline, which is critically important for South Africa with its fragile debt situation. Inflation has also stayed low. While it's picked up in the last few months, levels are still low and have been kept low and aided by lower oil price and also a stronger currency. But most importantly has been the move by the Reserve Bank to lower the inflation target to the lower end of the band rather than the midpoint. Global returns have also been strong. You've seen a very strong rally in European indices, in particular their banking stocks. And in the US, technology shares have rebounded from the lows that we saw in April. These shares, known as the Magnificent Seven, have invested enormous amounts in artificial intelligence, and at the same time, their earnings have continued to exceed expectations. This investment in AI has been perceived positively on two fronts. First of all, that it can boost returns for these companies into the future, but the amount that is being invested is also positive on the ground for the US economy. So final tariffs have been finalized between the US and its trading partners, and as mentioned earlier, the level at which tariffs have settled has been more elevated than many market participants had envisaged. But we a few months into the implementation, and so far the impact of tariffs has been muted, both from an inflation and a growth perspective. But as we sit here today, we're waiting for a number of data releases which could change the picture. There are always a lot of moving parts and the environment remains complex. But in the process of generating wealth and meeting investor targets, it's always a balance between opportunity and managing risk. So in managing the portfolios, we are looking for those opportunities that can generate wealth for our clients, opportunities that are priced at reasonable valuations, and at the same time combining different asset classes into a portfolio to try and minimize the downside risks. So thank you very much for joining us today. As always, please feel free to reach out to the Personal Trust team if you have any further questions, and wishing you a great day further.